a guaranteed gain, like a fixed return, feels safer than a higher but uncertain potential return. But if we are facing a loss, we're more likely to take a risk.
Yeah.
But we need to be thinking about that and aware of that bias when we're making decisions, or we could get ourselves in quite a tricky situation.
Welcome to Checks and Balances, brought to you by Partners Life. I'm Michael Vincent. This is James Blair. And today we're going to talk to you about the psychology behind irrational money-making decisions.
We're back in your life. And Michael, we're going to start with a game show today. Checks and Balances, the game show, the day you've all been waiting for.
Yeah.
So, Michael,
There's not going to be any math questions,
I've got 2 questions for you, and you have to choose between an A and a B.
I can't go past 3 times tables.
Okay. Would you prefer to win a guaranteed $500?
Yeah.
So $500 you don't have, or flip a coin to win $1,000, but if you get it wrong, you win nothing?
500.
You'd like guaranteed win $500?
Yeah.
Okay. Scenario 2. Would you like to accept a $500 loss?
Yeah.
Or flip a coin, and if you lose $1,000, but if you win the coin flip, you lose nothing?
I'd probably go for the second one. I'd probably go for flip the coin. Yeah, go on.
Well, interesting answers, Mike. Most people opt for safety in the gain scenario, which is what you did, right? You said, I'll take $500.
Yeah.
And gamble in the loss scenario, which exactly what
I
you did. You're just another guy.
I've never claimed to be anything different.
Yeah. So today is all about, in financial advice, we talk to clients all the time who make irrational money decisions.
Yeah.
And are thinking about, today's all about the psychology of money, and not just mathematically what is the right thing to do, but all the things going on between our ears and how do we deal with them. Mike, loss aversion.
Yeah.
So, it's 2025. We said, hang on till 2025, it will get better.
And we hung on.
Right now, though, a lot of people still have a lot of losses. Share market, a lot of wins, unless probably you're in the New Zealand share market or got some commercial property investments.
Yep.
But property investors still very much in the red, right? So there's a lot of, people are getting tired. There's the risk of making a bad decision at the moment, isn't there?
Yeah, 100%. Now, I had a really interesting discussion with some customers yesterday, and they listened to the podcast. So I haven't told them, so I'm going to use them as an example, where they didn't want any lending. What they wanted to know is, should I sell this property, right? They don't live in New Zealand. They're living overseas for a period of time. They're going to be returning back to NZ. And cash flow, they're looking at it. The cash flow is not negative, it's positive, but they're like, I don't know why we would hang on to this property. We have to top it up every week. It's in a central Auckland suburb. They've done pretty well off it. It was their owner-occupied house. They could probably sell it for about 1.7 million at the moment, right? When the market's down quite a bit. And all they wanted to know was, we're going to sell this property, play devil's advocate for why we shouldn't sell it. So they had almost already made their mind up, right? Now that's very straightforward for me to answer. Hang on to the bloody property, right? For a number of reasons, and I won't go into all of them. Interest rates coming down, market going up, etc. But it's really interesting that is a real world example of the way that people are feeling at the moment.
Yeah, absolutely. I mean, very common at the moment. The other one that I see all the time is people who want to move owner-occupied homes, and assuming they've got enough equity to still be able to do the next thing they want to do. A lot of people go, I want to wait for my property to go up in value before I sell my house and then go buy a bigger home because I need another bedroom or something.
Yeah.
But mathematically, you go, that makes no sense at all, because you're buying and selling in the same market, and the more expensive home is down more, which means like you should do it now. But a lot of people go, well, Mike, I renovated a bathroom, or I've done the deck, and I've put time into this, and I want to get my money back. And it's like, dog, doesn't matter. Like it is what it is. Those renovations means that you've just not lost as much money. But people really struggle to get past that.
Yeah. And there's a number of reasons why that is, right? And it's not just environmental around where we're at the moment in terms of the market cycle, houses being down. A lot of it is around the psychology of money and how people making those decisions. And we didn't rehearse that at the start. I was just making those decisions on the fly. And it kind of illustrates that actually most people make decisions or they come to the same outcomes in terms of their decision. So, for my customers yesterday who I was talking to was saying, we're going to sell this property. That's not unusual to feel that way or think that way about your assets at the moment.
Yeah. The other one I see all the time is the DIY share investors. And they go, these stocks are in the red. I don't want to sell them while they're in the red. And it's like, okay, are they going to go up in value? Because just something has lost value does not mean it's going to go up in value.
Yeah.
And you're thinking something in red will perform something that's already positive, but the positive could continue to outgrow the other. Another perfect example is like, should I invest in Queenstown, which is positive in terms of the capital gains in the property market, versus Wellington, which is like negative 20 or 30%.
Yeah.
And it's like, just because Wellington's down doesn't make it a better or worse investment than Queenstown. There's lots of other factors, but we look at those things in a very interesting way.
Yeah, it's funny because I do tell my customers to avoid Wellington, and someone called me out on it. They're like, did you not just do a property investment in Wellington? I was like, yes, I did.
Yeah. Oh, isn't that me in my own words? Another one when it comes to like loss aversion in finance is, and I want to be very careful here, over-insurance. So in general, Kiwis are very underinsured. If you haven't had an insurance conversation, whether it's house, contents, life insurance, income protection, whatever, make sure to do it. But there is a portion of people where they still don't like to get rid of the insurance, even though, so they've met with me and I've gone, you don't need that much insurance anymore or something. And they're like, well, like the what if? What happens if I died tomorrow? And be like, well, you'd probably prefer to have kept the insurance, but you don't need it. We're paying money on premiums. It's an interesting one.
Yeah. And again, it comes down to what is the person thinking? If we break that situation down, if I die tomorrow, I wish I would have had this insurance, right? You haven't died, yet. So if you were to cancel the insurance or reduce it and die tomorrow, that would be an anomaly. That is an irrational thought to have. And making decisions around those sorts of kind of irrational thoughts or beliefs is what's going to lead you to, making bad financial decisions. What if I died tomorrow? And we're not saying go out and take all your insurance away, but, using the extreme as the point or the reference for you to make your decision is not the right thing to do.
Yeah. And the thing with loss aversion, right, is you just have to appreciate everything has risk. Investing is risky. Not investing is risky. We're all going to die. So we're not coming out of this thing alive anyway.
Yeah.
When it comes to loss aversion, conservative investors, I would argue in lots of cases, carry more risk than those that are willing to invest in shares or invest into property or start a business, because we don't think about the opportunity cost as much as we should.
Yeah, 100%. And opportunity cost, I love that. As a student of economics, like marginal thinking, opportunity cost, those are things that I really love, right? And everything has opportunity cost. And to James's point before, not doing things has an opportunity cost. Keeping your money in cash has an opportunity cost, and a very real opportunity cost. And you can say the same thing as you're weighing up two different investments, right? It's not just, do I do something or not do something? Two different investments will have different opportunity costs as well.
Before we move on, we talk all the time about planning and growing our wealth, but protecting that wealth is just as important. That's why having the right insurance in place can help when life goes unexpectedly.
And that's why this episode is brought to you by Partners Life, a New Zealand operated award-winning insurance provider with over 300,000 Kiwis insured and 89% of claims paid.
Partners Life understand that having some insurance is better than having no insurance. They have flexible and personalized solutions for any budget or situation.
Check out their website in our show notes below.
So, Mike, if you like this kind of chat, I'll hit you with another one.
Here we go.
Conjunction fallacy. So this is the idea that we choose investments that sound appealing or align with a narrative that we believe, rather than focusing on probabilities. What do we think?
Let me hit you with some of the ones that I hear. Fisher & Paykel. Great brand. Known it for ages. Solid investment. You have no idea if Fisher & Paykel is a great investment. I want to get a house near my house at the moment so I can drive past and look at it. That'll make me more is more reassuring, and great investment. You have no idea if that's a great investment. You will never go look at the house. These are really common things that we hear all the time. People link, ideas about an investment to an investment and then make a decision on it.
Yeah. And I think like in terms of financial advice, the point in my career where you get confident enough to go, that makes no sense, like, is a very important thing to hear from a financial advisor. You don't want to just be a sounding board for a person, but sometimes like, we've just been thinking about these things in our head, or we have a perception, and we're not actually going, what is the math behind this? If we're investing into Fisher and Paykel Healthcare versus a diversified fund, or we want to be able to drive past their house versus because I'm in Christchurch versus actually the right opportunity is in Auckland, or whatever it might be, just thinking about things from a different perspective.
Yeah. I have some great conversations. I ain't even making this up. I was speaking to a customer yesterday, him and his wife leaving their jobs, moving to Sydney, right? And he's like, I'm going to sell my house and I'm going to buy an investment property. So we've still got a foot, on the ladder here in NZ. I was like, perfect. And they're like, I've seen this amazing apartment in College Hill in Auckland. I was like, love the plan. One tweak. Don't buy an apartment. Here's the math behind it. Here's why, it's probably not a great idea. And I don't think I've convinced them yet. It was a bit of back and forth. And what I was trying to say is, just because you want to live there doesn't make it a good investment, right? And we hear that all the time. And it's where people are confusing owner-occupied properties with investment properties. As soon as you get that mix of, I like the carpet in this house, there's wrong way to think about it, right? And that is one of those conjunction fallacies that often trips people up.
The other one I see all the time is when somebody has made all of their money in property investment and then they get to 60 and they go, oh, James, I've got all this equity. I would love some income so I can go on holiday. And you're like, cool, sell a property, invest into some shares, take an income, erode the capital over time. And they're like, nah, I don't trust shares. like I like property. I like to look at it. I like to
look how well it's worked for me.
Yeah. Look how well it's worked for me. And it's like, you're just going to die really rich. You have no income. Another one for you, Mike, which we have been victims of, the anchoring effect.
Yeah.
So the anchoring effect is when you get told that you're going to be able to buy something at this really cheap price. Let's use property because it's very relatable. You're going to be able to buy a property that's worth $1.5 million for $1 million. And you're like, this is an amazing deal. And you can't actually get the property for $1 million. You have to pay $1.2 million. You really struggle with that because you go, I thought I was going to get $500,000 discount. I'm going to get a $300,000 discount. It's still a great deal.
Yeah.
But because of where you started, where you're anchored from, very hard for you to get your head around. And when we talk about, Mike and I have suffered from this, you may have heard Mike and I bought some properties together. We thought we were going to get a better deal. The valuation would be higher. And we got very close to walking away from it because we thought the deal would be better.
Yeah. And the anchoring bias is something that people use in negotiation as well. So, if you're listening to this and you're going, oh, no, I wouldn't fall for that. It works when if you're negotiating, you throw out an anchor if you have to make the first offer, either really high or really low, right? And, people, that is the point that you start thinking from. That's where you start negotiating from. That's where your expectations come from. So it is a very real effect and something that people suffer from quite a bit.
Yeah. So coming back to that coin flip right at the start, I think we're very prone to biases, right? Like the game show that I just did with Mike, a guaranteed gain, like a fixed return, feels safer than a higher but uncertain potential return. But if we are facing a loss, we're more likely to take a risk.
Yeah.
But we need to be thinking about that and aware of that bias when we're making decisions, or we could get ourselves in quite a tricky situation.
Yeah, 100%. And the other thing I would say around that is, we're talking about, hold on till 2025. It's going to be better in 2025. And I still firmly believe that, right? I still think we're in for a really great year. But when you are making these decisions around your finances, what to spend on, what to invest in, slow the decision-making process down. You're not going to be sitting there thinking, okay, yeah, this bias, this, and running through all of this to see if the decision you've made is a good thing or a rational decision. But slow the process down and think about the process you're going through, right? What was the first offer? What's the expected return? If I took away the first offer and I still got that return, would that be fine? One of the things I really love doing with customers is when they say, I've got to top up the investment property by X amount per week. And I go, and I'm not really sure I want to do that. I go, cool. Average, house price growth over, 12 months of the last 20 years is 6%. If I said to you, you're going to trade, I don't know, $20,000 for a $60,000 or $70,000 return, how would you feel about that? They go, yeah, I'd do it all day long. Or, I'd do that all day long. That's all you're doing, right? So think about different ways you can frame the decision around what you're doing before you do it.
Yeah, 100. I mean, you nail on the head. This, the question is, what do you do about all of the things that we're talking about? And it's just awareness.
Yeah.
It's about having, I love the customer that you talked about, which is tell me all the reasons my idea is wrong.
Yeah.
And sometimes, and I'm guilty of this, when I have an idea, I don't like to be told. Once I've made up my decision, I can see Em laughing in the background. I'm like, I'm doing this thing. But I think it's very important to put your ego to the side, be open to ideas, and just go, well, give me other, views of this, and how can I make sure that I've got all of the information to make the best possible decision I can at this point in time.
Absolutely.
Awesome. Okay, well, lots to think about. Flip a coin. What are you picking? Are you making money? Are you losing money? Tell you one way that is just a guaranteed win, apart from me saying, much love to Partners Life for sponsoring this episode. A guaranteed win, subscribing to the channel, writing Mike and I a lovely review because you appreciate all the time and effort we put into the podcast, and give us a like, and we will catch you next time.
Cheers.